Okay, in this video we're going to be looking at what's meant by public companies and sort of some key information about the share market. So first of all, there are different types of investments, but there's also different types of companies. So when we're talking about different types of investments, we're looking at different ways you can invest your money to try and maximize your returns. So you can invest in property, shares, put your money in the bank, superannuation. You can invest in digital currency, so things like Bitcoin and things like that, or you can buy more obscure things like antiques. And there are pros and cons associated with these different types of investments. When you hear the word investing your money, it's talking about the different things you can do with your money. In terms of types of companies, we're really only going to focus on public companies here, but there are other types of companies. So a sole proprietor, that's when one person owns a company and they contribute all the funds or they borrow money. So there's not investments in those companies. There's partnerships, which means that two or up to two to, I think it's 20 people can invest in a partnership. Again, all the money comes from the partners or borrowing money. People don't invest in those companies. And then there's your bigger companies like your private and public companies. And the difference being that a public company, anyone can invest in a public company. So they're listed on the stock market, which means that they're free for people to invest in these companies. Um, Whereas private companies, you need to be invited to invest in those. So in terms of the key characteristics of a public company, they have to have at least 50 shareholders, and those shareholders generally receive dividends, and we'll talk about what that means in a second, but they have to have at least 50 shareholders. Shares can be bought and sold by any person or company, and they become a part owner in the company. So you don't need to be invited to purchase shares. They can be bought and sold by any person or company. Um, they're run by a board of directors. They're listed on the Australian Stock Exchange if they're Australian companies, and they generally have the word LTD after their name. So the key characteristics are that public companies are bigger companies, generally with multiple hundreds of shareholders, and anyone can buy a share in that company, um, assuming they have enough money, and that they shares are bought and sold on the Australian Stock Exchange. So that's what you guys are doing as part of a share market. A share or a stock basically is a unit of ownership in a company. So when a company goes public, they will issue shares, and that's a way to raise funds for that company. Anybody who buys a share becomes a part owner in that company, and then whenever the company makes profits, they're able to generate some of the revenue from those profits. Some businesses become so large that they choose to become listed, which means that people they get put on the stock exchange, and then people can buy and sell in those companies. So the stock exchange, there's over 2,200 Australian companies listed on the ASX, and they're divided into different sectors, but we won't go into that. When companies want to raise money, they decide to go public, and basically what that means is they're going to issue shares to the public so that people can become part owners in that company. By paying for the shares, each investor buys a part ownership or stake in that company, and then they can buy and sell shares to other investors as well. Control of public companies. If you have more than 50% of the shares of a public company, you have control of that company, which means that you make the decisions. Whereas if the shares are more spread out, then there's more joint ownership in that company. So anyone who has a share technically has a say in the running of that company. But if you have more than 50% of the shares, then you essentially have control of that company. Two key words you need to be aware of: dividends. Whenever a company makes a profit, they will distribute dividends to their owners. And basically, what that is just like a reward for investing in a company. So it doesn't mean your share prices increase, it's just an extra sort of incentive. So they might offer, say, a 5 cent dividend per share, which means if you've got 500 shares, you get 5 cents times 500. So you'd get whatever that is. You might get $25. But if you had 50,000 shares in the company and they say a 5 cent dividend, then you're going to be able to get, say, $2,500. So dividends are just like when they distribute side of the profits to their shareholders. Capital gain is the money that you make when your shares increase in value. So if you buy shares for $20 and sell them for $30, you've made a capital gain. In terms of advantage of becoming a public company, if you're a shareholder in a public company, you have what we call limited liability, which basically means the only thing you can lose is the value of your shares. If that company goes bankrupt, you can't be forced to sell off your assets or your car or your house. You only lose the value of what you put in terms of your shares. They allow owners to raise a large sum of money to basically grow the size of a business. So that's why a lot of big businesses are public companies, because it allows them to become much bigger businesses and then operate on a much grander scale. Investors can sell their shares if they want to leave the business as well. But in terms of disadvantages, they often take a lot of large setup costs. There's a lot of legal requirements you've got to comply with if you run a public company. And often investors have a lot less say. So if you're a sole proprietor, you have basically complete say in your company. But in public companies, it's often harder to have a sort of genuine say in the running of your company. So two key words, limited versus unlimited liability. Limited liability means that you can only lose the value of what you put into the company, so you can't be forced to sell your own assets if the company goes bankrupt. Where if a company has unlimited liability, that means the owners of the business are liable for the entire amount of debt and obligations of that business. So if they're forced, they can be forced to sell their own belongings and their own assets if that company goes bankrupt. So if you start up, for example, a sole proprietor and you invest 50,000 into it, the company goes bankrupt and you end up owing people more than 50,000, they can force you to sell off some of your assets, like your own cars and shoes and stuff like that. They won't make you live on the street, but they will make you sell off a lot of any sort of luxury items that you have. In terms of the market for shares, there's what we call the primary and the secondary market. So the primary market is when a share company first goes public, and they basically create shares and sell them to the public, and they become listed on the Australian Stock Exchange. So the initial selling of shares is the primary market, and they might issue a certain number of shares in initial public offering. So they might say we're going to sell 50,000 shares at $2 a share, and then that allows them to raise $100,000. If they sell 50,000 shares at $10 a share, they can raise $500,000. So it's the initial selling of shares to the public for the first time. So companies go public, they sell shares to investors, investors buy and become shareholders, and then they make money if share prices increase. The secondary market is the one where you guys are trading in the share market game, where shares are bought and sold between investors. So the idea is that you buy shares with the idea of trying to make a profit. If there's more demand for company shares, share prices go up. And when people try and sell their shares, shares go down. So when we've had a pandemic like the coronavirus, a lot of people have lost faith in the ability of companies to make a profit. So a lot of people want to sell their shares, and that's what causes the share market to go down. So if more and more people sell their shares, then share prices will fall, and then people will lose money. But if more people want to demand shares of companies, then share prices will go up. The main difference is the primary market is when you initially sell shares for the first time. A private company becomes public, they sell shares, whereas the secondary market is where you buy and sell shares between investors. A stockbroker's role is to try and encourage you to buy shares. So they sell shares on behalf of clients. So I showed you that quick clip of Leonardo DiCaprio trying to sell shares. That was basically he earns a commission every time he sells shares. So you pay a brokerage fee, which essentially is paying the stockbroker for buying and selling shares on your behalf. So their role is to get you to buy shares in companies, and the share market will generally trade between 10 a.m. and 4 p.m. each day. In terms of demand and supply for shares, shares in public companies are bought and sold on the share market, and it's like any other market. When there's more demand for shares, prices go up, and when there's more supply of shares or people want to get rid of their shares, prices go down. So in the second market, demand for shares is basically people looking to buy a share in companies with the idea of making a capital gain, and supply of shares is when people want to sell their shares because they think the share price is going to go down. If demand for shares outweighs supply, then share prices go up and vice versa. So some of your key factors increasing demand for shares, it's basically anything that makes investors think that prices are going to go up. So if they're confident about that company's profit potential, often when other countries are growing faster, the demand for a lot of our companies increases. When there's lower interest rates, a lot more people demand shares because they're not getting a very good return on their savings. So shares become a more attractive substitute. So people invest in shares rather than putting money in the bank. Often when the dollar goes down, a lot of our companies make more money because foreign companies want to buy our products. So that causes the demand for Australian shares to go up. When there's a takeover, foreign companies need to buy our shares to take over a company, and that causes the demand to go up. If they make higher profits, anything sort of technological breakthroughs or anything that causes demand for products to go up. So when Pokemon Go was created, Nintendo share price went up, for example. They've just come up with a good product. If Apple release a new iPhone that sells really well, their share price will go up. If it sort of tanks and say, with the iPhone, I don't know, whatever we're up to, iPhone 12 or something, doesn't do as well as what we think, then their share price will go down. These are mainly the opposite. The reduced consumer confidence, higher interest rates, businesses generally don't make as much money. When the Australian dollar goes up, generally companies where we're exporting make less money because overseas companies don't want our products. Weaker overseas growth rates, lower profits than we think. Um, when it's cheaper to invest in other things like gold, less people invest in shares, so that can cause share prices to go down. If a company's selling a product that gets superseded by another product, so say there was a smartphone that was better than Apple, then that's probably going to lead to Apple's share price going down.